Hi, everyone. This is Paul Scheuren with Impact DataSource. Thank you for joining the webinar today. This is our second of a three-part series on economic development incentives. And today's webinar, we're going to be focused on impact analysis and what economic developers need to know. So cutting through the jargon and looking at how you can analyze the impact of the deal. And that's really where it is for most economic development professionals. We care about how the deal impacts the city or the state or the county. Based on the registration list that we have, I can see we've got a great group. We've got some state level folks. We've also got some local economic development professionals. I think we span about 23 states based on a little bit of background research that I did on everybody. And so I'm going to try and make this relevant for everybody. I see we also have some national organizations and some consultants or businesses on the call today. So my goal is going to be to hit this from several angles and make sure everybody gets something out of it. But forgive me if most of my presentation is directed to those state and local ED professionals. The slides will be posted online, and I am recording this. So we'll follow up with an email where you can find those items. It's going to be on our website for the fall ED webinar series. You'll get an email at the end of the full series. So on Wednesday, you'll get an email. Next Wednesday, you'll get an email that has all of those links. So let me jump right into things here, and I'll just start with again. My name is Paul Scheuren with Impact DataSource. I'm an economist in principle. Who is Impact DataSource? We're an Austin, Texas-based economic consulting company that specializes in economic and fiscal impact analysis. We develop tools like models where our clients can do impact analysis themselves. We also are consultants, and so we can prepare one-off analyses or kind of on an as-needed basis. We work almost exclusively with economic developers and public entities. We've been doing this for well over 20 years. Many of you know my partner and Impact DataSource founder, Jerry Walker, who presented on the first webinar of the series. But today this is just going to be me, so with that stuff out of the way, let me get started into the presentation. So impact modeling for economic development, what exactly does that mean? Are we talking about just the jobs and salaries and economic impact and all that? In my opinion, the answer is no. Economic developers, as I said, are almost always evaluating a deal. And when you think about an economic development deal, it obviously extends well beyond the hardcore economic impacts that you think about. If you don't know what hardcore economic impacts are, we're going to get into that today. But with the impact of an economic development deal, we want to know how the deal will affect the city's fiscal position. So will the city get a bunch of new tax revenue? How much? Will the city have additional costs to support this project or its workers? Will this project affect the city's population? I keep saying city here, but this could be true for the state or the county or even the school district, and we do want to look at all of those different angles. And so if a project is seeking incentives, how do those incentives and credits and exemptions feed back into all of those fiscal impacts? And then can I calculate a rate of return, and can I figure out when the city or the state will get paid back? So our agenda for today, I'm gonna decipher some of the jargon by looking at the impact analysis terminology. We're going to outline a typical impact analysis, and then of course look at an example. And we're going to slice that a couple different ways. But first, I want to start off with two big reminders, and I want to illustrate these two warnings or reminders with a story. And I'll start with the punchline so you kind of know where we're going. And this first reminder here is that all models are wrong, but some are useful. And so that's a quote by a statistician by the name of George Box. It's always a good reminder anytime you're modeling something, before you get completely buried in the weeds, you got to stop and remind yourself that, hey, this thing's never going to be a perfect reflection of reality, but how can I make it useful for my purpose? And then second, I want to remind you to chart your course carefully. This one's pretty true just in life in general, but I'll illustrate what I mean a couple of different ways. And so kind of to discuss these two concepts a little bit more, I want to give you a quick story about a cross-country road trip by a ragtag group of guys with a Ford Mustang and a dream. And this ragtag group included my dad, Jack, and his brother, Frank, and their good friend Rodney. So in 1965, Jack, Frank, and Rodney traveled from where they were living in Pennsylvania to Houston for the opening of the Astrodome. And they drove my dad's 1964 Ford Mustang. They took a picture of themselves on a steer, and they may have even gotten into some trouble with the law. But most importantly, out of all of this, in order to get from Pennsylvania to Houston, Jack and the gang used a model. And so simply they used a road map, which a road map is just a model of the highway system. Okay, and the roadmap illustrates our point beautifully that all models are wrong, and in some cases, a roadmap can be extremely useful for a cross-country road trip. So a roadmap isn't the full scale. It leaves out detail. It doesn't represent the cornfield you just passed or the restaurants or the gas stations up ahead. It isn't a perfect representation of reality, but it never could be. You could never fold it up and fit it in your glove box otherwise. But the roadmap obviously is useful for that task at hand. So just to say it again, don't seek perfection in a model. You won't find it. Look for a model that's useful for your purpose. Now, that was 1965 when my dad and Jack and the gang made the road trip, and now it's 2015. What if Jack and the gang wanted to relive their experience and make that road trip again to Houston for the 50th anniversary of the Astrodome? Well, for one, they probably wouldn't use that tattered old road map to get to Houston. Everyone's got a GPS system in their pocket. And now you've got turn-by-turn directions, you've got traffic, it'll tell you which route is the fastest, when you'll arrive. You'll also be able to find all those cornfields, restaurants, and gas stations along the way. So clearly, models have improved since 1965. And so I think you're probably convinced that a sophisticated model can make the journey easier. And maybe that's the lesson. I mean, don't settle for a folded up roadmap when you've got Google Maps or something like that. And that could be true. But we might be forgetting one other thing. What happens when Jack and the gang roll up to the Astrodome in 2015 after taking the fastest route, after avoiding all that traffic, after hitting every Starbucks within 1 mile of their route, and arriving precisely on time for the first pitch of the season opener? Well, Jack and the gang might be disheartened to learn that the old Astrodome was vacated in 2000. And the Astros play in a new stadium. The Astrodome hasn't been imploded yet, but it might not be exactly as they remember it. So to this point, before you make some big plans for a road trip and before you start using that trusty model, make sure you know where you're going and why. So to summarize these 2 points, again, I can't say this enough. Number one, all models are wrong. Some are useful. Your focus should be on not on perfection, but you should ask yourself, is this useful for my purpose, or how can I make it more useful? Number two, chart your course carefully. Before you put that model to good use, make sure you know where you're going and why you want to be there. Otherwise, you may show up at the Astrodome in 2015 ready to throw out that first pitch. Applying this a little more directly to economic development, think about the companies you're looking to attract as economic developers. Why do you want them? What will these targeted businesses do for your community? And so this goes to those steps that Ellen talked about in the webinar, on the first webinar of this series. It goes to some of those steps before ever using a model. You can model nearly anything with an impact analysis tool, but do you want to, and what would you do with the results? So again, have a clear idea in mind and chart your course carefully. So with that out of the way, I want to kind of jump into a sentence that I may or may not be guilty of writing in a report, but it's pretty common in economic impact studies, so stop me if you've heard this one. So it usually goes something like this. Including direct, indirect, and induced impacts, the project will create 200 jobs, increase labor income in the region by $9.5 million, support $25 million of economic output, and increase the region's gross area product by $13.5 million annually. Well, I need to take a breath after that, but I'm pretty sure you and your board and your city council and newspaper subscribers would all be thoroughly impressed by that sentence, although not sure what it meant. It sounded good. And so I'm going to break down a lot of that terminology. It's all just jargon. Really, I want to break it down and give definitions of some of those things. But really, one thing I want to point out is that this type of information usually falls short of what most economic developers need. So what you're looking at is a description of the economic impact of some project or business, and very rarely does an economic developer that we work with want to know the economic impact of, say, the aerospace industry in Florida. I'm not saying it's not a worthwhile study to do that. I'm not saying that information couldn't be useful at some level. I'm just saying that in our experience that 9 out of 10 times economic developers are evaluating a deal, so they want to know how the impact of the deal affects them. And so economic impacts are just the start, and I'll get into what else is useful in evaluating the impact, but I want to untangle all of this jargon before we get too much further. So this next slide, I'm going to talk about that first phrase there, including direct, indirect, and induced. So direct impacts are really just a description of the initial activity. These are the impacts supported by the project or the business itself. They're pretty easy to understand. The indirect impacts quantify the supplier activity. So that direct business buys a bunch of stuff, a bunch of inputs and from its suppliers, and they're making their product. And so the indirect impacts reflect this amount of activity supported by the spending. So these are the business-to-business transactions there. The induced impacts reflect the worker's activity. So the induced impacts represent economic activity supported by direct and indirect workers spending money at retail stores, restaurants, banks, gas stations, and so on. Sometimes you'll hear indirect and induced impacts referred to kind of together as spin-off impacts. And then also sometimes you'll see indirect and induced separated out in studies. So there's a lot of variation in different studies that you might see, but just be aware that kind of at their base, that's what those mean. If you've been paying attention carefully, you might know that you might have already caught me that I've been saying economic activity like everybody knows what that is, but I'm gonna get into that in the next slide here. Economic activity is measured a couple different ways, and so here we're gonna talk through the major ones. So jobs or employment, as it may be presented sometimes. This is the easiest one, but there's a little bit of a caveat maybe. So typically this is reported as a head count of jobs, so not in terms of full-time equivalents. So jobs or employment consists of a count of jobs that include both full-time and part-time workers. And so in this way, if you had 10 full-time workers and 10 part-time workers, that would be reported as 20 jobs. Studies vary in how this is reported, but most models are going to take this headcount approach. Next up, we've got labor income. Might also be called household income, or excuse me, household earnings or workers' earnings. That's the total amount of income paid to all the workers and owners. That includes wages, salaries, employer-provided benefits, proprietor's income. Some studies might report salaries, which, depending on how things were calculated, could be correct too. And again, there may be variation between the different models that you're using. Economic output is the next one on the list there. Sometimes that's referred to or called gross output or output. That's just the dollar amount of all the sales made or the value of goods and services produced in the economy or in that chain of events for that analysis. So economic output is the sum of supplier inputs as well as the sale of those final goods. This is a duplicative in total, so that goods and services will be counted multiple times if they're used in the production of other goods and services. So in a sense, you're kind of double counting some things, and that usually gives us our biggest number. If you want to kind of cut through that, what you can talk about would be the value added, and that would be the total dollar amount of only the new sales, essentially. So this is kind of like economic output less intermediate purchases. So that might be a little bit more useful number. And now I also said gross area product in that big long sentence, and so this is really just kind of the local version of the national economic measure that's known as GDP or gross domestic product. It measures the size of the economy, and so at the local level we might be talking about gross area product or regional product or metro product or state product. It's all kind of the same exact thing. Just based on the region that you're talking about. So one more time, we go through that sentence again. I think I cut through a lot of that. We've got the sentence being, including direct, indirect, and induced impacts, the project will create 200 jobs, increase labor income in the region by $9.5 million, support $25 million of economic output, and increase the region's gross area product by $13.5 million annually. I gave you some definitions. I'm not sure that really gets you much further in terms of understanding how this is going to, really affect your city, but we can see that maybe this is some good information. One thing that I left out, though, as we kind of threw in there, it says that the labor income in the region or the region's gross area product. So let's talk about region before we go any further. So we're talking about region of analysis or the impact area. And so in the simplest terms, if you're a state entity, you probably want to know what will happen in your state. So what's the economic impact of this new project in my state? Okay, and so when I moved to Texas, I had to take a pledge, and so that pledge and my Texas state pride prevents me from using any other example at this juncture. So please bear with me as we walk through a Texas example. if a project locates in the best city in the world, Austin, Texas, the state of Texas might be interested in knowing how many jobs that project will create statewide. So in terms of those spin-off impacts, how will this new business be using suppliers from Houston and El Paso, San Antonio, Laredo, Amarillo? Now, if the company buys a bunch of stuff or supplies from Oklahoma, those dollars are leaving the state and lessening the impact. So those expenditures are leakages and will negatively affect the economic impact. If the region of analysis is Texas, we don't really care what happens in Oklahoma. No offense to our friends in Oklahoma. Now think about what the impact would be in Travis County, where Austin is located. So we've got these different geographies shown here in these maps. So the impact in Travis County would almost certainly be smaller than the impact at the state of Texas, because all of those purchases for supplies or inputs that were made to businesses located in El Paso or Houston would now be viewed as leakages if the region of analysis or the impact area was Travis County alone. And so now go that one step further and say, what's the impact on the city of Austin? So this is going to be even smaller still. So my point here is to define your region of analysis carefully, and in the simplest terms, don't use state multipliers if you want to know the impact of a project will be in your city. So you'll be overstating what would happen in your city using a statewide analysis. So I want to do just a quick multiplier example. And so here I'm going to use RIMS-2. There are a bunch of good economic impact tools out there. RIMS-2 is produced by the Bureau of Economic Analysis. As I understand it, the RIMS-2 folks are making new multipliers available next week based on more recent data. They've been kind of stuck for a little while with the current data that they've got, but next week they're going to be publishing newer multipliers. There's private service providers too. EMSI or MC and Implant are examples of providers that have an economic impact component to them. REMI is a little different, a little more complex, a little more expensive, but that's kind of something too that helps you do economic impacts. But I'm going to do a kind of an easy example here with RIMS-2 just to illustrate how a direct effect multiplier can be applied and how multipliers vary by industry. We already said that they varied by region, but we want to be clear that they also vary by industry. So first, let's look at a manufacturing company here, and we've got multipliers for the Austin MSA, and we've got some sort of electronics thing. It's a printed circuit assembly manufacturing. We've got a type 2 direct effect employment multiplier of 2.99. We could almost call it 3. And let's say that there were going to be 100 direct jobs at this new manufacturer. And well, to estimate the total jobs, it's pretty simple. We just take the number of direct jobs and multiply by that direct effect multiplier, and we get just about 300 jobs, 299 jobs. If we think about that real hard, we can figure out what that means, that there's about 199 or about 200 indirect and induced jobs. And so how do I know that these are indirect and induced jobs, kind of both of those things together? Well, we're using a type 2 multiplier, and a type 2 kind of in the input-output lingo. Type 2 just means that it would include indirect and induced impacts in that total multiplier number. The other version of the multiplier would be a type 1 multiplier, and that would just mean that it includes only the indirect activity. Okay, so that was a manufacturer. What about like a restaurant or something that maybe won't have as big of an impact? So if we have a restaurant here in the food services and drinking places industry, we've got, again, a type 2 direct effect employment multiplier of 1.39 this time. So let's say now we've got 100 direct jobs, but these are restaurant jobs. We apply that multiplier again, and we would get a total of 139 jobs to be created. And again, we'd have 39 indirect and induced jobs. So that's pretty much how that works. There's a couple other versions of those multipliers. It can get a little more complicated, but it's at least with RIMS-2, it's almost that straightforward. But that's enough about economic impacts for me. As I said, economic developers need more than just economic impacts. So what I want to talk about now would be, how does a deal analysis or an economic developer's impact analysis work? And so for that, we've got a recipe, and I've typed it up here in recipe format for us. We've got one part economic analysis, we've got several parts fiscal impact analysis, and a splash of incentive analysis. So in my mind, and for most economic developers, we need to be able to pull all of these parts together. So the economic impact, the fiscal impact, and then some analysis of those incentives. And so we can see on the directions, we're going to measure the economic impact, strain out the fiscal impact, and then whisk in incentives to a smooth consistency. We're going to bake that at 375 degrees for 10 minutes, but I don't know if that's going to be long enough for some of the city council or board members to kind of get on board with it. So your bake time might be a little bit longer, and certainly the prep time, 5 minutes seems a little bit short for that. So let me go through kind of a slide almost similar to what we talked about the other day, explaining how all these things come together, or how we view this information coming together, and so why it is that we want to get the economic impact, estimate the fiscal impact, and then be able to compare these incentives. And so this is kind of our view or point of view on economic development. And so if you have a new business or some sort of new economic impact occurring in the community, so a new business with more sales, you're going to have new jobs, some new activity, all of those economic impacts that we talked about. And there are going to be some spin-off activity, some of that occurring in your specific community or even generally in your state. And that's going to drive fiscal impact. So all that economic activity is going to result in some additional tax revenue. So if the company is building a new plant and it's going to have some taxable property, if there's going to be taxable sales associated with things, maybe the workers are going to be subject to income taxes. So the city, the state, and so on are going to be receiving some benefit from this in additional tax revenue. And then it's not all gravy, so we've got some additional costs to account for, maybe from police, fire, EMS service, those sorts of things. As you have more activity in your community, new business, more people coming through, we've got to account for those costs. And now if we put everything together, we want to, in a big picture sense, we're trying to improve the overall quality of life. And so we can kind of try to measure that by looking at that change in social welfare. When we look at what benefits will this project bring us, less any costs. And so if we look at that difference, we can see that if the revenues are higher than the costs, the city can maybe provide more services or lower tax rates. And so that's kind of a big picture of where we're going and why we're trying to connect up these things of economic impacts, driving fiscal impacts, translating those things, and then also kind of layering in how incentives might work. So we've got a video explanation on our website. You can check that out. It's like a 2.5-minute video. I'm not going to play it right now and sit here and let it run. But if you're interested in kind of a full explainer version of this, we've got a video out there. It's really cool. It really does a good job of explaining that. So now I want to talk a little bit about fiscal impacts. And so just as I said before, we've got additional revenues and costs for public entities in its simplest form. These are things like taxes, fees, charges, even maybe lease revenue. If you're an ED organization and you have a business park and you own it and you're leasing out parts of that, that could be another source of revenue for you. And then on the cost side, we've got, the city or the state or someone has to pay for public safety, education, infrastructure, and those sorts of things. So we need to be able to account for those costs. This is kind of a big one for us. So we think, anyway, a proper analysis requires more than just a big aggregate total table of tax revenue. So to say that state revenues will be, it will increase by $1 million a year as a result of this project isn't exactly helpful. We want to know which tax revenues will increase or what revenues will increase. And particularly if you were to say, the local tax revenues will increase by $500,000, local is a pretty broad term, and we want to know maybe how is the city affected, how is the school district affected. So what we suggest, what we want to get into, the type of detail, is being able to break out the property tax line items. We want to determine who gets what share of local sales taxes, if those apply, and how do local income taxes work? Who gets what? Is it based on residence? Does the money on income kind of follow the resident back home, or is it based on the place of work? There's a lot of variation out there in how what you could call local income taxes are applied. And then also, when we're talking about a state, for sure, we want to look at what are the state's major revenue sources and how do we account for those. So I put together a little bit of an analysis, and I stared at it for about a week, and I'm not sure if this is going to make sense to anybody, but I really think it's kind of interesting. It shows some of the variety of the tax revenues. So what we're looking at is the source of tax revenue on a nationwide basis for state and local taxing entities. And so of all the tax revenue that a state receives, property taxes account for only 2% of that tax revenue uh, nationwide. So if we look at all of the states, add up all the states, look at how much the states collect, each individual states collect in property taxes, that only accounts to 2% of the tax revenue that states in general collect. If we look at that, the next bar over for local entities, we've got 73%. So that what we're saying here is that at the local level, local taxing entities rely on property taxes much, much more than state entities. Obviously, there's variation across different states and different communities and different, even taxing entities from a city to a county to a school district. But just kind of breaking with me right now for between the state and the local, if we look at this, we can see that the major source of tax revenue for states would be coming from first sales taxes, then individual income taxes, and then much lower down on that list would be property taxes. I've left off of here, it's not out of the denominator, so these percentages are based of total taxes, but I've left off corporate income taxes and some other taxes that are much, much smaller percentages. But these are kind of the main ones that you think about both at the state and the local level. We've got property taxes, sales taxes, and individual income taxes. Again, my analysis is here. You can see the source at the bottom. I'm looking at the Census of Governments for this data. And if we think of this at the local level and we look on kind of the lighter shaded ones, property tax is the biggest driver. Sales taxes are also important, and then individual income are at a much smaller level. But what's important here is not really what happens at the national level, because no one really, when you're in Austin, Texas, or you're in Muskogee, Oklahoma, you don't care exactly what happens at the national level. We kind of have a big off-the-shelf kind of average. That's not very useful. What we want to know is kind of specifically based on the local tax structure. So just kind of showing that there's some of this variation, we can say that, again, the source of local tax revenue nationwide, property taxes accounts for 73% of that local tax revenue. But some of those northeastern states, Maine, Connecticut, New Hampshire, New Jersey, Rhode Island, they get 99% of their local tax revenue from property taxes. And we think about sales taxes, again, that on a nationwide basis, it's maybe 17%. Well, there's some states where the local entities will rely on that for almost 50% of their local tax revenue. So Arkansas, Louisiana, and Oklahoma are getting a significant chunk from those local sales taxes. And then individual income, while it's relatively small, if we look at it on the national level, if we look down on the actual states, some of them rely on it quite heavily. Maryland, District of Columbia, Kentucky, Ohio, Pennsylvania, Indiana rely on those local individual income taxes quite a bit. And again, we can look at these differences on the state versus local from the state's perspective. And so again, property taxes at the state aren't that significant nationally, but when we look at specific states like Vermont, New Hampshire, Wyoming, and Arkansas, they're accounting for a pretty big chunk of those taxes. Florida, South Dakota, Washington, Nevada, and Texas at a state level are relying on sales taxes much, much more than the typical state. And then individual income taxes are a major driver in places like Oregon, Virginia, New York, and so on. So we can see how that variation occurs. So what's the point of all of this? Well, every state and community is different. And so, looking at some of those big averages might be interesting to kind of point out some of the differences as we're talking kind of here today to a national audience. But every state's different, and the local tax structure drives the impact analysis, or it should drive the impact analysis. And so don't forget, the taxes aren't the final word on revenue. There's charges and miscellaneous revenue. There's intergovernmental revenue. What about utilities there? At the local level, maybe a city's providing some utilities. Does the city lose money on those utilities, or might they make a little bit of a margin? Is that kind of a profit center almost for the community? And so there are, beyond the taxes that we just talked about, there's other sources of revenue that should be accounted for in understanding the local tax structure. So now I'm going to talk a little bit about incentive types. And they're just kind of all over the board in terms of how these different types of incentives, what different states can do, what different local communities can do, and different programs they have. Some of the economic development organizations are kind of, private partnership things, and so they maybe have other options that strictly a city economic development department might not have. But in a big sense, let's just say that there's kind of statutory incentives and there are discretionary incentives. And a statutory incentive might be something probably tied to the state's revenue code. And so that says maybe there's something in there about if you invest X amount in a particular industry, you get this corporate income tax credit. That would be the case. And so you check the boxes on these, whatever the criteria might be. That's a statutory incentive. That's what you get. You get this credit or exemption, or maybe it's cash, but less often it's usually in the form of that credit or exemption. And then on the other side of that are the discretionary incentives, and that's where there's some leeway. It's not just set in stone. It's not just a matter of checking boxes. Now, kind of on a separate level, this doesn't really fall under, it's not like these incentives are going to fall under one of these necessarily or the other, but just be aware that at the big picture sense, there's statutory and there's discretionary incentives. Underneath that, you can get even a little more complicated or a little more involved, and we've got revenue reducing. If we can turn our head to the side and read that, we've got on the left revenue reducing incentives. These are things where you're going to give back some of the money that you were getting. So you've got an abatement, a rebate, an exemption, a fee waiver, a reimbursement. Those, they're pretty much saying all the same thing, but they're called, every state and every local community kind of calls things a little bit differently. So I want to hit all the terms. But big picture sense, let's say that it was a property tax abatement. We were supposed to get $100,000 in property tax revenues, but we've abated 50% of that. So we get our revenue reduced by this function. A rebate would be the same thing. Even if on abatement, they never really pay the money. On a rebate, they pay the money and then they get it back as a rebate. From the analysis perspective, it's really the same thing. And so in these cases, we see kind of just modeling that in and being able to capture the value is very important. The next category over here that we have is cash or near cash. And so this is where there's really kind of like money out of pocket or some value that we can calculate and translate that really just isn't reducing a revenue, but it's actually kind of costing us some money. So infrastructure improvements, that could be if they're building a new building here and it's going to cost $250,000 to run the water line out or to extend the road or whatever it might be. If you're considering if the incentive on the table might be to cover either all or some of those infrastructure improvements. You've seen these too of a job creation grant if it maybe it has to fit a particular criteria, but then if those jobs are retained or maintained for a certain period of time, they'll get X amount per job. You can also think about this, and we've got a couple other kind of cash or near cash incentives to talk about. You can think of this in terms of discounted land. So if an ED organization owned a piece of land or a huge area of land, maybe they're going to sell it to a private company and they're going to put their new facility on it. If the ED organization gives them a discount on that, you might want to think of that value of the discount as an investment as this cash or near cash incentive. The same thing could be true of a below market lease. If you decided to offer a discount on maybe lease space in a business park, that could be thought of as cash or near cash. The final category that we have there is just kind of other. It's kind of a catch-all. There's probably a bunch of other funky things we could have thrown in here. I'll kind of talk about two of a little bit more common ones. We've got tax increment financing district, and so that would be just kind of, there's a couple ways to think about it. If it's on the upfront, obviously that tax increment financing district is collecting revenues that will probably be used for the benefit of the development activity. So it might be, being that that revenue is going back to pay a bond, and that bond was, set to kind of cover the infrastructure improvements up front, maybe for that area. Um, Later on, maybe that's when you're setting up the TIF or the tax increment financing district. But later on, if a project locates in the downtown area that's already kind of part of a TIF, as you're running your impact analysis, as you're looking at the fiscal impacts, you need to recognize that based on the details of that TIF, the city may not collect all of the property tax revenue that it otherwise would have if it wasn't located in the TIF district. So that definitely comes into play. And then there's loans or forgivable loan programs that might require a different type of analysis as well. And so we're gonna talk about how we model, or how we suggest folks model some of these incentives, both the revenue reducing and the cash or near cash. And we can talk about tax increment financing districts, but we'll focus maybe on the more common things. So I'm going to jump straight to a couple examples. We're going to first look at Impact Dashboard, and this is our web-based impact tool. You can check out a demo at theimpactdashboard.com. And then I'm also going to show you a couple examples from our Total Impact 2.0 model, which is our customized desktop-based impact tool. And so you can see more about that on our website as well. But let me jump to this impact dashboard. I've got an example pulled up. Let me see if I can get over to that. So you should be able to see my screen. I think I confirmed it here. So we're in our impact dashboard model. I'm going to go in here. We've got this project beta set up. And I've got right now 2 different scenarios that I'm considering. I've got 75 jobs, but with a 3-year phase-in, or 75 jobs kind of all thrown into year 1. The company wasn't sure, so I wanted to kind of do 2 different versions. I'll go ahead and take a look at this one with the 3-year phase-in and kind of give you the setup for this manufacturer. So here, this is our tool. This is the impact dashboard. We have a number of screens here to kind of look at, to do a number of the modeling. First tab here is for the scenario info. This is kind of giving the information about the project. This is, as you can imagine, the number of jobs, the salaries, the capital investment. Okay, and this model that I'm in right now is set up to be reflective of a Texas community. And so property taxes are significant, sales taxes are significant. As you can imagine, we work with communities and states across the country, and so depending on what the revenues might be in other states, the model would be different, it would look different, it would ask different inputs, but each one is customized based on that state or based on that local community, honestly. But so just kind of give you a big picture overall of what we've got here. We've got a scenario subtitle where we see that's my 3-year phase-in. We've got a description of the project. This is going to flow through and appear on our report. We can specify which taxing districts are affected. So we've built in all of these different tax rates, or excuse me, taxing districts, built in all of these assumptions and different parameters that are associated with these entities. Again, I've kind of made up these cities, so it's my city, my county, my school district, and so on. But you can see we could add, if we had 9 taxing districts, we could have 9 taxing districts. If we only wanted to look at the city, we could just focus in on the city. The next main input here is for we want to know what industry this project is in, and so we can pull up our multipliers, and here we're kind of using an adjusted multiplier so that we can estimate the impact at that local level. So it's just as easy as kind of typing in what the industry here. So if we go to auto manufacturing, automobile, we can see, if we pull that up, what those multipliers might be, and computer terminal and other peripheral equipment might be the same in that big category of manufacturing. We can also kind of overwrite multipliers if we know more or think we know more. We can overwrite things. But as we scroll down here on the left-hand side, we're seeing the inputs for the job creation. As I mentioned, we had 75 jobs, and we were going to assume that they were kind of phasing in over a 3-year time period. Now, as we think about that, we've got 75 new jobs being created in the community. What we want to think about is those 75 workers that will fill these positions. Where are they going to come from? And so I think in general, we all hope that a big number of a significant number of the 75 jobs will be filled by residents of this community, of my city. but it's likely the case that maybe some of these 75 jobs will be filled by people who live nearby and will just commute in, okay? But then there's going to be a portion, we think maybe, of the 75 jobs that would be filled by people that are moving to the city. So they say, hey, there's this great manufacturing company moving to my city, and I want to go take a job there. I'm going to move to that city. And so we've got a default built in here for this, just kind of based on this city's size, location, commuting patterns, and so on. We've got an estimate, kind of a default of about 7.5% of the jobs will be filled by new workers moving to the city. And this is an important piece because we're going to be able to pick up some of those additional benefits and some of those additional costs as a function of new households in the community. And so let's say that this manufacturer told you that they were going to be hiring heavily from the local area, and they didn't expect anybody to move to the city as a result of this. And so we could go in here and adjust that and say that 0. And so that 0% of our new jobs, of these 75 jobs, would be filled by new workers. We could also, if maybe thinking about a different type of project, if it was a relocation and we knew that they were going to bring a significant number of their workers with them, maybe it's more than that default value. Maybe it's something like 25% of the new workers would move to the area. And so how is that going to affect the analysis? I'm going to set this back to the default just for now, but you can see how this is a critical assumption to make. And a lot of times you have a little bit of information to understand what types of jobs are these. Can we compare this against our local workforce information? And you know, you can really kind of fine tune things as you work through an analysis at a local level. I'm going to reset the default there. Or maybe. I think we'll leave it at 25. Next, we can enter salaries. I've gone ahead and entered 85,000 already, but maybe we want to say that these will increase at a different percentage. So we could type in 5% annual increases, and so now our annual salaries increase at 5%. As we scroll down here again on this left-hand side, we've got capital investment. And we're listing, we're asking for inputs related to the value of the land, the buildings, and other real property improvements. So in this sense, we're separating out real property because we want to be careful about how we're accounting for real property. And then furniture, fixtures, and equipment, so kind of a business personal property that you could think about. In this case, I've left off land, or I've basically left land at 0. In this case, I'm thinking about we want to capture the net impact on the community, and so we don't want to account for the fact that that land was already on the tax rolls. Now, if this was a piece of land that I was selling to the business, maybe then it would be coming on the tax roll, so we want to capture that. The buildings and other real property improvements, so this is going to represent a construction project, and they're building a $250,000 building for this. But their biggest capital investment will be in the form of this FF&E, and so we can see what that looks like. We're going to make some assumptions over time to calculate the taxable values of these things, because we're going to do an analysis over 10 years. You can see it's already kind of run over here on the right-hand side. But we're going to assume that the real property, if there's any there, will increase over time, so it'll probably have some appreciation. By default, we typically use about a 2% real property appreciation. On furniture, fixtures, and equipment, we're going to build in a depreciation schedule, and that might vary on the type of property this is, but generally we can put in kind of a generalized version of a depreciation schedule to capture that effect that over time business personal property will be depreciating. Now, the next input would be related to maybe that construction project, and so if there's some building permits and fees, we want to capture that source of revenue for the local city. And then also taxable inventories. So in this case, we've got a manufacturer, they've got $2 million in inventories. They expect those to increase at 5% per year over the time. If we wanted to, if we knew that maybe they were going to jump up to be maybe 5 million in year 5, we can overwrite that and let that run at the 5% increasing before and beyond. But these taxable inventories are important here in Texas because Texas taxes inventories, but they may not be in other states, and so, or inventories rather, may not be taxed in other states, and so we wouldn't have this in say, a model for the state of Florida or for a client in the state of Florida. As we scroll down, we have a few more things, just trying to pick up everything we can in terms of taxable purchases or taxable sales. And so here we've got an input for that. Again, in Texas, local communities typically have or rely pretty heavily on a local sales tax in addition to that local property tax. So from here, before we get to the public support tab where we can model some exemptions, I'm going to take a look at the report. And so here we've got two different versions of the report. We've got kind of a one-pager that shows us some of this, some of the values. We've got 75 direct jobs, and this is representing the total jobs, so 103.8 total jobs. We can see the average salary of the direct workers and then the average salary across all the workers, summary of that capital investment that we had, and then also a summary of that residential development. If we think back, we had some workers relocating to the area, about 20 of them, and that's going to drive some residential investment as well, and so we're estimating that maybe 3.1 homes might be constructed. If we get down to the revenues and costs for our actual city, we can see that's composed of sales taxes, some real property, some FF&E, and some inventory property taxes. We've got that new residential property tax revenue, those building permits and fees, some utility revenue. These are city-owned utilities. And utility franchise fees, and then as well as some miscellaneous taxes and user fees. So to the extent that we can itemize our sales taxes and property taxes, we're going to do those as best we can. On miscellaneous taxes and user fees, so things like fines, forfeitures, permits, other charges for services but we didn't otherwise collect. Those miscellaneous taxes and user fees may change as a function of the overall business activity in the community, or with these new households, these new workers moving to the area. On the cost side, we've got this cost of utility services and the cost of government services. The cost of government services representing kind of that marginal cost to provide additional city services to the new residents and the new business. So on a net basis, we're looking at net benefits of about $866,000. We've got a present value there of about $700,000, because again, this is over a 10-year period. We can see what that looks like. Now we can go, so that's just kind of the raw numbers. If we go back, we want to model some different public support. In this model, we've got the ability to look at some property tax abatements. And so here, if we wanted to kind of make Texas a little more competitive, we could abate or exempt all of those inventory taxes. And so we do that here. We can see what that looks like. And so our property tax liability for this company, that their liability to the city at least, drops from $731,000 down to about $565,000. And so that's going to affect our net benefit. So if we go back here, we can see that now our net benefits are a little bit lower by that amount of the abatement. And so we can see that we're now at net benefits of about $700,000. And so this is an example, again, of a revenue reducing incentive. We can also look at one of those cash or near cash incentives. And so here we've got an example of an analysis tool that we've built in for non-tax incentives. And so if the company has asked maybe for a $150,000 incentive to cover some infrastructure improvements for this new building, we can calculate, we can compare that incentive, thinking of it as an investment, compare that investment to the return on investment, which would be the cumulative net benefits for the city. So in this graph, we've got this blue line that's representing our $700,000 over the 10 years. We've got this line showing our return. So now if we put in that incentive of $150,000, how does that break out? So we can calculate a rate of return and a payback period. We can see that our rate of return is almost 50%. Our payback period is just about 1.4 years. This tool's pretty nice. We can slice it a couple different ways. If we wanted to think about maybe the city would consider an incentive that would get paid back in 3 years, but we don't know what that incentive might be. If we type in 3 here, we can calculate, and we can see that now the total incentive is $300,000. And so we've got that payback period of exactly 3 years and a rate of return of about 23%. Again, as we go back to that report, we can kind of see how things have updated. We've got a representation of those incentives. We have a detailed report that goes into a little bit more information on some of these things, kind of gives a real report format version of showing how the jobs, salaries, taxable sales break out, those population impacts, how many people are moving to the area, the value of taxable property in the city. This is, again, this is our web-based tool. This is really kind of flexible and customizable. We have a handful of clients on this already. This just was released just a few months ago. We've got a handful of clients from a handful of states on this. It's a really exciting tool. But our pro version, or our kind of desktop tool, is our total impact model. And so I'm going to switch to that right now. And so we can see here, I've gone ahead and I've plugged in Project Beta for this model, and this one I've set up. This one is one of our clients in San Angelo, Texas. So again, it's a Texas client. But we've got the ability to kind of take into account a possible tax increment reinvestment zone. Here's in Texas, it's called a TERS or a TIERS. We can scroll down. We can see these inputs are very similar to what we had in the other model about asking about what industry to get our multipliers. We have a section in our desktop model that asks about current operations. So if you're looking at a retention and expansion project, you might want to know what impact does the company have now, and when they make that expansion, how much bigger will their impact be? So what's the existing impact, what's the value of the expansion, and what would be their impact in total? We also ask for the same types of inputs as before. We've got the capital investment, the number of jobs and salaries. There's a few more kind of inputs that you have here. You have a little bit more control over things with this desktop version. The web-based is definitely a little more streamlined for its purposes, but they basically get at the exact same answer. This model has an assumptions tab where you can kind of review all of the tax rates and other assumptions that we've built into the model. We've got this same public support tab where we can do the same type of analysis. Again, we're basing it now on San Angelo's tax rates, and so what's the value of that property tax abatement on the inventories here? What's the net collected property taxes? This model has the ability to look at sales tax rebates, also calculate that land purchase discount. So if the city was considering selling a few acres of land and they're giving them a discount of 50%, what's the equivalent land discount? And so here we've calculated it to be about $75,000, not a bad deal. And we can see if we add that in here, and we can separate it out or kind of isolate it. The land itself is just a pretty good payback period there, less than 1 year. If we wanted to add another for those infrastructure improvements too, maybe it's 150,000 for that, and we can see how that affects things. And again, this report in our desktop model kind of prints out in very similar to a Word format, and you can see all of the same types of economic impacts and information that was in that other report. Just to kind of show you some more variation, I want to take some questions toward the end here. So I know we're coming down to the last few minutes, but we have a Florida client, and so here again I've put in project beta. We've got different inputs again for a Florida client. As I mentioned, they don't have inventory taxes. And so here we don't even have to give them an exemption on inventory taxes, but they do have, maybe this project qualifies for the state's QTI program, so the Qualified Targeted Industry Tax Refund Program, and that sometimes requires local participation, and maybe the city and the county are both going to participate in that. And basically what that is it can be an award per job paid out over a series of years. And so if we had a $4,000 award per job, and it was paid out over 4 years, and the city had to match 10% and the county had to match 10%, we can calculate that rate of return and payback period in both of those cases. This QTI incentive is actually pretty minimal in terms of the incentives as we compare it to the net benefits. We can also do that same analysis that we did, maybe that, again, the $150,000 incentive here in Florida, based on Florida's taxing structure, or Tampa or the Plant City's taxing structure. We're coming up with a 2.1-year rate of return, and again, our reports can kind of summarize all this information. We can see specifically, for example, in this case of Plant City, what are the different sources of revenues, and we've got impact fees built in here and some other sources of revenue, and franchise or inventories didn't apply. So these are all kind of very customized tools. Let me jump back to PowerPoint. I got just 2 more things to say here. I'm kind of trying to wrap this up. So the series continues next Tuesday, November 17th. We're going to talk about kind of on the other side of this, how to monitor, collect, analyze, and report things. If you go to our website here, we're going to get the videos and the slides and all that posted up there. You got my contact information here. We're up against the very end. If there are some questions, I can take those now if you want to type those in. I know we're basically 3 minutes before the top of the hour, so if there are any questions, I'll take those at this time. I know we had one. The one question we have here was relating to all these models were set up maybe for a 10-year analysis. Can you do a different length if in Texas, a lot of organizations are doing the Chapter 380 agreements, and those, while tax abatement in Texas is typically tied to about 10 years, 380 agreements could be written for longer. We can do an impact analysis of any length of period. So these models, or any length of time, excuse me, these models can be done for 10 years, 20 years, 25 years, whatever it might be. And so that is just, based on what would be most relevant. I think in terms of trying to decide should the model be set up for 10 years or 15 years or 8 years or whatever it might be, I think having a consistent length of period, length of analysis is useful. And honestly, I mean, even 10 years out, you're kind of like just guessing at that point. 10 years, who knows what's going to happen in 10 years. So it gives you a nice long look if you are considering an abatement that might last 10 years. But otherwise, it's really, I think a 10-year analysis is certainly long enough. Now, again, if you have an incentive program that's going to extend beyond that 10-year period, you might want to look at it. And just to clarify again, our PowerPoint slides for this presentation and all of them will be made available on our website, and we'll also have a video of this, the whole webinar series on our site. And so I'm almost out of time here, and I think I've kind of answered most of the questions that came in here so far. We just had a couple. If there's any other questions that you want to ask on this, feel free to do so now. I might be able to take those. If you wanted to just kind of ask a more specific question, because as I kind of acknowledged throughout this, that different cities or different states, kind of everything is a little bit different. We can talk about maybe your specific situation. If you just want to send me an email or give me a call, we can address it one-on-one, or maybe to get together on a GoToMeeting here and talk through a specific issue or problem. But with that, I'm gonna end things, and I thank you for joining the webinar today, and I'm looking forward to the third in our series, the final webinar on Tuesday. I look forward to catching everyone then. Thank you very much.